All right, what's up, Winning Wealthers? We're back. Episode 11, Jeff and Brock here. Today is going to be an awesome episode. We're doing a deep dive on Sam Zell, who is the absolute GOAT of commercial real estate and just had an incredible career and life in general. A lot of great perspectives in both business, real estate, and life as well. So let's get into it. We're going to start doing deep dives, as I mentioned in the intro. Wink, wink. And we're going to do deep dives and bios on people that we find interesting. We read a lot of books. We listen to a lot of podcasts. And Sam, he's been called the Grave Dancer. That's one of his nicknames for being opportunistic and capitalizing on opportunities for deals in real estate. And there's been a lot of times where he's bucked the trend, and the herd is going one way and he goes a different way. And so we're going to kind of chronologically go through some of the events in his career, and then we're going to talk through learning lessons with what we've found out from this. So I think let's just get right into his story here.
Yeah, so I'm going to kind of walk through yesterday I did a huge deep dive on him and kind of go through a timeline of who he is and where he got to where he was. The teaser, I guess, is in 2007 he sold his company for $39 billion. So this
with a B.
To put into perspective how big of an investor he was. So all right, so kind of setting the stage here. So his parents were Polish immigrants, fled the Holocaust, had a crazy story. Without going too deep into that part of it, they tried to convince their whole family to leave. They didn't want to leave. Essentially, they settle in Chicago. So Sam Zell was born in 1941 in Chicago. And his parents teach him early on that the streets in the United States are paved with gold. Anything is possible, and set the expectation of big things for him, right?
And just because I got to interject, I'm not trying to cut you off or anything, but I think there's a lot, when you study, you see that a lot with immigrants, right? There's a different appreciation and perspective that immigrants will have. And when that's instilled in somebody at a young age, they look at the world differently. They look at the United States and the prosperity and the opportunities that this country provides. So I just had to. I'm gonna jump in here and there without trying to.
No, I agree. Yeah, you see, it's a common thing. People come, they're hungry, they want to kill it.
They want it.
Yep. So yeah, as a teenager, he never really fit in. His parents really were applying pressure for him to pursue a conventional career. So he goes out to University of Michigan, goes to law school there. Never really loved college, but saw it as the right thing to do. Get a law degree, set yourself up for a good career. And during his years in Ann Arbor at the University of Michigan, he starts buying properties. So, over those few years he was there, he ends up owning a whole city block of properties. His father ended up becoming a prominent businessman, partnered up with him to buy some of those properties. So accumulates this portfolio throughout his college years. And he said his senior year of college, he made $250,000. So that's back in the, what is it, like the 70s.
Yeah.
It's a lot of money while you're in college.
That's a ton of money.
Yeah.
The other thing that I would say there too is, we talk a lot about raising capital, doing deals, how to put deals together. He was resourceful enough to go and find the opportunities and then bring those opportunities, to his dad, partner up with someone that has capital, and make them both some money. So I think there's a lesson there too, right? He was in college. Most people in college don't have any money. And maybe it's easier if someone has a parent that'll partner with them, but the fact that it doesn't really matter where you can build that trust and go find capital to do these deals. It's out there. You just have to find the right opportunities and spot the gold in the streets.
Yep, 100%. So he gets done with college. And is going to pursue his law career. So he sells his entire real estate portfolio in Michigan and moves to Chicago to go after that law career. Starts a job at a law firm, and after a few months there, quits essentially, and decides he wants to go back into real estate. He wasn't a fan of having a boss and following the rules, so really wanted to go back into real estate and picked up where he left off. So ends up partnering back up with one of his college buddies. So they become business partners. And one side note on that, he went into depth in one of the podcasts I was listening to on him. He says their business partnership, there was never a friendship, which I thought was really interesting. He said business always came first. He said once a year, him and their wives would have a dinner, and that was the only social interactions they had ever. So it was very much always business, no social. And I thought that was interesting. I think that's not as conventional because normally people become business partners like us, right? Like we're friends as well. So a little bit different of a take, but he talked about that.
And I think that, I don't remember hearing that when I just listened to another podcast about him. I've read his book a number of times. But to address that, I think, going into business with someone is, in a way, sometimes people call it like getting married, right? Not that we're married, but so I think there's benefits to being friends as well. But, this guy's had a lot of success and, and that's the way he did it. So it's an interesting perspective.
Definitely. Yeah. So his first big deal he talks about was in Toledo, Ohio. Everyone he talked to advised not to buy that deal because no one was really buying big apartments in smaller markets. Everyone was more focused on the big cities and seeing opportunity there. So he buys this deal, and we'll later talk about kind of his philosophies with investment, but he saw there was no competition in this market. So he goes out and buys it. And he talks about in the early days, like not even really like having a full perspective on how to underwrite or analyze a deal. He said all he looked at was the cash on cash return. And that first deal was at 19% cash on cash return when 4% cash on cash was the norm and what everyone else was doing. So did that deal, even though he wasn't super educated on it, killed it. The deal went well, and continued on that path, right? Started doing a few more deals. And at that time, he was having investors blowing him up saying, hey, we want to invest with you. How can we do this? So in 1968, he creates Equity Group Investments. And that's his firm that is focused on acquiring distressed assets and turning them around. So value add projects. So he launches that. And then in around 1973, he foresaw a huge commercial real estate crash coming and began accumulating capital and being ready to buy assets at a discount, right? So he sees this. This is the first example of how he got his name, the Grave Dancers. He saw this opportunity coming and prepared for it when a lot of other investors might not have seen it coming. And of course, he was right. The market crashed in 1974, and he was able to scoop up a ton of properties at a discount and make a killing. I think that's, again, the first example of him kind of just timing the market and seeing what's coming. And I think that sort of foresight in investor is very few have that. I feel like it's very hard to know where you're at in the market and understand what's coming and have the confidence and strength, right, to say, hey, we're going to take a step back, let's hold off, let's accumulate some capital and prepare for what's to come.
That right there, and a lot of things about Sam Zell remind me of the Oracle of Omaha, and we'll do a deep dive on Buffett sometime. But Warren Buffett says, be fearful when others are greedy and be greedy when others are fearful. And I think Sam Zell does that over and over and over again in real estate. Even what you were talking about before with the deal in Toledo, Ohio, he was chasing high yield, 19% cash on cash return. Who doesn't want that cash flow? Mm-hmm. Cash flow is the lifeline of the business. It just seems to me, while he was a smart guy, he worked very hard, and would have been great at whatever he did. He was so intuitive with figuring out what deals are going to make sense, and then courageous enough to not follow the herd, and it's paid dividends throughout his career.
Yep. So then Eisenhower passed this bill called the Cigar Bill, and within that bill there was language that allowed for something called a REIT, which is a real estate investment trust, which essentially allows smaller investors, it's kind of like a stock. You can put a very minimal amount of capital and get involved in a big portfolio of real estate. So after the savings and loan crisis in the 80s, Sam Zell pivots to this REIT concept, and he's really one of the pioneers in the space for REITs and goes all in on that concept. So in 1989, raises his first fund, the Real Estate Opportunity Fund. And this was really one of the first funds that was created to buy distressed assets. No one really was looking at it the angle of we're going to go buy properties that aren't performing and turn them around. Everyone was just buying existing properties that were performing. So again, a pioneer in a space that is huge now, right? Everyone's targeting value add deals. That's really what most investors are looking for nowadays. So I thought this was interesting. In 1989, he was going out to these pension funds, right? And going out on his capital raise, going out to raise a ton of money, which is really what you do when you get to that space. And 80% of pension funds didn't have real estate as an asset in their portfolio. Nowadays, I mean, I should have looked up the stat, but everyone has real estate in their portfolio, right? So he was going into these big rooms with big investors, and they were pretty much laughing him out of the room, like, why would we invest in real estate? Like, that doesn't make any sense, too risky. And he was going out and getting laughed out of the room. But, long story short is he, raises all the money, and that fund kills it. He really made him. That's what made a name for himself in the REIT space, which opens up. That's where the biggest players are, right? They're operating in the REIT space. That's kind of the top of real estate investing.
And the interesting thing about now is there's the institutional investment managers, pension funds. We're recording this in September of 2023, and I do a lot of studying about the different allocations of asset classes that these big wealth institutions have, and a lot of them are trying to reduce their exposure to commercial real estate. And so you kind of almost, it's a market cycle no matter what, right? So while they all do have commercial real estate, it's 20% plus, I think, of the U.S. economy, which he called, that it was going to become this major factor of the U.S. economy. Now some of them are looking at ways to reduce their exposure, right? Which inevitably on the other side presents opportunity for guys like us that are looking to rinse and repeat some of these things. Maybe that's a deal calling right now for us.
Yeah. So, as we started, right? So it's 2007. He's created this massive REIT portfolio. He sells the entire business 2007. Again, timing the market perfect, right? 2008, 2009 is when the huge crash happened. So sells it to Blackstone for $39 billion. And that's it. That's his big exit, right? That's really where he makes his fortune. So does that, and in 2000, kind of somewhat stays involved in the space, obviously, but retires in 2017 from Equity Group and still is remaining active, but really is when he kind of takes a step back and decides to pursue more philanthropy and not be as involved. And to kind of wrap up the timeline of this. So a couple of things I listened to one of his interviews, and it was in 2020. In 2020, he talks about, like, one of the questions I asked was, like, where do you think the economy's going? It seems frothy right now. And he says that we're in a period of substantial growth, which defers recessions. So he kind of said, I think we're going to continue on this path, and eventually a recession's coming, but it's not going to come for a few more years. Which, again, spot on, right? We're 2023. It's still in that somewhat of a period, but I think, in 2020, people were assuming the recession was coming tomorrow. So, it's, and I'd be super interested to hear, like, what his perspective would be today if he was around, obviously. And one other thing too that he was a big advocate of, again, in 2020, he was talking about was freedom of speech. So he was actually, Sam Zell was one of the largest donors to the Republican Party. He was huge conservative. So I thought that was pretty interesting. And yeah, so then he passed away in May 2023, unfortunately, and that's kind of the timeline, I guess, of what I saw his life was.
Yeah. So the interesting part too, when he sold that portfolio, I think there was another, and I'd have to go look. Maybe we'll do another episode or something on. But there was, so he sold off all these office buildings, and the reason for it was because he saw that there was. He talks about his first class in college being like an economics class. And the first day was the professor wrote on the board supply and demand, and he said that lesson stuck with him forever. And essentially, he saw within the office buildings or the office asset class that there was an imbalance of supply and demand, and the stats weren't reflecting it appropriately. He said there was a lot of WeWork, co-working spaces coming on. We could do a deep dive on Adam Newman sometime. He built this with SoftBank, this multi-$100 billion company with WeWork, but they weren't profitable. It was kind of built on trying to see the trend of remote work coming into play, which it did. But at the same time, it was throwing off the statistics of new supply and demand for office space. And so he said builders just kept building. And so he was selling his portfolio, and then boom. And then when COVID hit, it even, further showed that trend of remote work. And now there's a lot of, we're recording it, like I said, today in fall of 2023. Office is the place that nobody would want to be. And he was the biggest office owner in the world at that time, office space. So just very, very intuitive. And he looks at it from a perspective of trying to really figure out the true supply and demand. And that's probably a good way to get into these
kind of some learning lessons. So guiding investment principles. So we broke a few down here. Supply and demand is what he talks about. He talks about being the governing principle of everything in business. And that's exactly what you were saying. And a few other things that I found interesting was he always bought existing properties. I think he was involved in a couple development deals, but most of his portfolio was existing properties. He said, new construction development, there's just too many variables out of your control in development, right? Rates go up.
I can tell you that one right now.
We're going through this right now.
Sure.
There's so much can change because a development can be a 2-3 year horizon right before the building stood up. So he talks about why he didn't like development, preferred existing acquisitions, which is our business, right? And a few other things was talked about a little bit, but he always talked about what is your competition. Where there's no competition, there's better deals. So that's why he preferred smaller markets in the beginning stages. While everyone was flocking to Chicago and New York City and LA and buying properties, he was buying stuff in Ohio.
Yeah.
He built a portfolio in Madison, Wisconsin. So he was finding these smaller markets because his thoughts was, if there's no competition, I can come in and scoop these deals up. And I don't care as much about, declining population and all the stats going on, because I know the deal's great. It's got a great cash on cash return. And it's going to stay steady. Those are really like the guiding principles I saw from his investment.
So cash flow is the lifeblood of any business, right? If you have enough cash flow over and above your expenses and your debt service, you can, effectively weather any storms. And that's one thing that that we try to model, our real estate business after is really our core business is buying deals that cash flow on day one, and then trying to find value add levers that we can do to increase the value and force appreciation in the property. But if it's cash flowing and it's solid cash flow on day one, and we pair that with the right debt and the right asset management strategy, we feel really comfortable about those deals versus going out and saying, hey, we're going to go be developers. I know Sam Zell talked about, he's like, why would I go to, Phoenix, Arizona, or Atlanta, Georgia, or Houston, Texas, where they just breed developers? Those people just want to, they just want to stick a building wherever. It's the sexiest, part of real estate, being a developer and putting up an awesome new building. But there's just so many different variables to consider versus, hey, look, I've got this in-place cash flow. And if I do a few of these little things, I can increase the net operating income, increase the cash flow, increase the value of the property, and then boom, have a nice, a great return.
Yep, 100%. That's our business, right? One other thing I thought was super interesting was he talks a lot about identifying risk, and that being the most important thing when it comes to making a decision on the deal. So he talks about early on, he did some deals with Jay Pritzker. They did 10 to 15 deals together. He talks about, he alludes to that guy being the smartest risk mitigator he's ever seen. And one thing, he talked about a conversation he had with him, and Sam Zell was presenting a deal to Jay to do, and he was going through this long presentation of all the different factors in the deal. And Jay says, point number 6 right there is what the deal is all about. That's where this deal breaks or works. And so that's what he talks about, is when you're looking at a deal, figure out where your risk is. And if that risk were to kill the deal, you shouldn't do the deal.
I 100% agree. And I talk about this all the time when we look at deals. Typically, obviously I'm not a Sam Zell by any means. I'd say Adam's a wizard in having this crazy intuition, but I really try to think about, as much as possible, how do we manage the downside risk? How do we make sure that if everything goes, if the business plan doesn't go according to plan, shit is out of our control. How do we make sure that, it doesn't go belly up on us, right? Like, and I totally agree with that. I think that's the best way to evaluate any sort of investment opportunity. There's things that you like about the deal, and then it's important, and that's great to make sure you there's certain aspects that, hey, we really love this about the deal, but then the more important thing is to figure out what would you really hate about it? What could really go bad?
What's your downside? Exactly. And that ties into decision making. So to me, he was a great decision maker. He says like a great businessman comes down to how quick can you make decisions. That's what identifies a great business person. And a couple notes on that too is he actually said decision making is what separates the men from the boys. And I thought that was a very interesting quote. But he also talks about everyone that's involved in the decision making process of a deal needs to have money in the deal. So if someone's involved in the deal, they don't have money in the deal, their incentives are aligned with yours because they don't have a downside of losing the money. So he talks about like the executives at his company, he always made them, when they're working on big deals, write a check into the deal because he knew if they had their own money in the deal, they would be much more incentivized to make this deal work.
How many times, I mean, even in this is episode 10 or something, right? We've talked about ensuring that incentives are aligned, because ensuring that you're aligned on, not only like the whole deal, but just the vision, the goals, because if they're not, and one way to make sure that everything's aligned is that, hey, they've got skin in the game. And that's something that we talk about. You got to understand all the different players involved in a deal. The broker's primary goal, and I'm friends with a ton of real estate brokers, but their primary concern is getting a commission check. They want that deal to close.
Yep.
They're less concerned. I mean, the great ones are really concerned about your business plan, and they want to make sure that you're successful because they see it as the long game, and they want to do business with you over time. Potentially, they can help you sell that, trade that building in the future. But really, and that's where you're trying to find the people that align with your business plan as much as possible. Because and then you go down the list and figure out, okay, well, this person or this group is involved because of this, and so the more people that you can have that have skin in the game in these deals, the better.
100%. And he talks about too, like building one of the keys too for him was building a great team. So he was known for having employees that worked with him for 20 plus years. They were with him his whole career. And he talks a lot about, creating a great environment for people to work with you. But one story he would tell is he joked around that his office never had a door because the door was always open. And he created this environment that was he was easily accessible. I mean, at this time he's a very big CEO, right? And he created this environment where anyone could just walk into his office and talk to him.
Yeah.
So I thought that was interesting when you really think about it. It's easy to say now when you're in the building blocks of your business, like, oh, I'd always be there. But you build this massive empire and you're still just talking to whoever and kind of growing the business and being there as a mentor.
And that kind of just speaks to him as a person too. I mean, he says he invented business casual. He wears jeans to every meeting, right? That's just his style, right? And I think that's also the laid back style of, I'm not above you guys because I can go buy a $10,000 suit and I wouldn't even notice it in my bank account, right? Like I got my door open, I'm wearing jeans, we're all aligned on the goals, and we're all trying to make money together. And I think there's a lot of things that I hate to, that I would say that we're trying to emulate with what he does within our real estate business is how can we make sure that everybody's aligned on interests? How can we have a great team that has full transparency with each other? We don't take things too seriously. I mean, I'm dressed up now, but I can tell you, Adam's probably not. I know you're not. Adam's probably got shorts on right now. Looks like he's golfing, but and maybe he is. But it's that sort of mentality that I think breeds the best teamwork and culture. And then teamwork and culture is going to beat, we're in football season now, right? Teamwork and culture is going to beat talent, so many times. So I think that's a great point to make too.
Yep. And then, so one last point here is he talks about being an avid consumer of information. So one quote he said was, "You can't be an entrepreneur if you aren't curious and consuming information." So he was known for, he talks about, I mean, he's old school. He'd read 5 newspapers a day, 3 magazines a week, and 1.5 books every 2 weeks. So he was always consuming information. And one interesting story he talked about was he was reading in a newspaper or something about some small town in India just opened up a Gucci store. And he'd never even heard of this town before. And he was like, how are they opening up a Gucci store there? That signifies wealth, right?
Yeah.
So he hops in his plane, goes and visits the town right away, like the next day, and sees what's going on. And of course, invests in this country or city and, kills it. So it's like always consuming information and taking action quick was one of his traits. Because he says the more information you consume, the better you can become at decision making. If you have an idea of what's going on in the world, and that allows you to mitigate risks and make decisions quick. So I thought that was, and he also talks about he would travel 1,000 hours per year in his plane because he always wanted to see things in person, meet people in person, instead of just, he'd read about it, of course, but then as soon as he saw an opportunity, he would make sure that he saw an actual in person.
Yeah.
Which I think is kind of a dying trait, right? Is the convenience factor of doing things online, Google Maps or a Zoom call with someone, of course, makes things easier. But I think at the end of the day, nothing beats physically going out and walking a property or walking a new market.
Meeting investors, meeting clients, meeting people in person. The relationship goes that much further, right? You can really get a sense for how it's going to be working with that person. And I think, being a voracious reader and consumer of information, you hear it from everybody. You hear it from Warren Buffett and Charlie Munger. You hear it from Mark Cuban. These people just read all day, and they're always trying to consume information, whether it's newspapers, books, whether it's nowadays Twitter. You're getting real-time information right away, or X, whatever you want to call it, right? Like, there's so many ways to do that, and I think it's just having a conscious effort to always be trying to stay ahead of the curve on whatever it is that you're interested in business and in life. And I think by doing that, you're able, like you said, you're able to make better decisions faster because you're ahead of the curve on that.
100%. All right, so last part of this, a couple quotes that I just pulled out that he would mention. You call them Samisms, right? Is I think what he alluded to. One I thought was super interesting, not a detailed one, but he would always say, "Tell me about your deals." Yeah. So he's known for being a really brash person. He'd like walk straight into a room, right? And like someone would be asking about something, and he'd just say, "Tell me about your deals," because he was trying to figure out like what sort of deals is this person doing, how are they performing. So he'd always ask that question. What I think is a super cool, super like straight to the point question, but I almost laughed like when he talks about it because it's just super brash, like, "Tell me about your deals."
Exactly. You want to know what someone's working on and how it's going, how well. You can evaluate so many things by asking somebody about their deals, right? You can evaluate, how well that person knows what they're working on, right? How well that person, how do they think through getting into that deal? What an exit strategy would be? What, do they know their numbers? Like, how's it performing right now? You can get so much by asking sort of an open-ended question, and that's in anything in business, right? Tell me about what you're working on. What's going right, what's not. I think I love that, and I'm going to incorporate more of that myself.
Yeah. And then on that topic too, another quote he would talk about was in his early days of investing, right? I was talking about how he wasn't like super educated on real estate investing. He just kind of was doing it. His approach to analyzing a deal was take the bottom line and multiply it by 6, and that's the price I'll pay for the property. So you mentioned like he would go on, he'd be talking about a deal, and he'd pretty much just say straight up, take the bottom line, multiply it by 6, that's what I'll pay. And, that kind of became the guiding principle, right, of like cap rates and kind of analysis of deals. But I thought that was interesting because, of course, like when you get into further deals, like you have to do a detailed underwriting, spreadsheets. Like I do a lot of that, right? But I think the more I see people that have been doing real estate for 30 years and that are huge players in the space, they do that component, but they're more so they can walk a property and just get a general idea in their head and back of the napkin be like, this property's worth X dollars, right? And it's like, then I'll spend 10 hours in a spreadsheet underwriting. And it's like, yeah, it's same number I got, right? So it's something I think you grow into, right? As you can just kind of look at something and say, that's what the property's worth.
For sure. One quote that he had too, that it's not even on here. This is your doc, but he said something about every day you own an asset in your portfolio, you're choosing to buy it, right? Like you're essentially you're owning that. You could sell it right now if you want to get out of that deal, and I think it's an interesting way to look at it. Now a lot of properties you're within real estate specifically, you're performing a business plan to add value to it, but you have choices, right? So like it's an active choice to continue owning what you have, and that's because you might like the future prospects of it, or if you don't, you can make a choice to move on.
Yep.
And I thought that was an interesting quote from him too.
Yeah, I like that. He also says, on the topic of numbers, he said one thought he always would say is we suffer from knowing the numbers, because he always had a pulse on what properties were worth and what you could pay for a property for it to work. And he sent that out to, his close group of investors that he knew that he thought highly of, because he knew, like, we know the numbers, and in times where people were overpaying for properties, they weren't doing deals, right? They were at a halt.
Yep.
And they kind of felt like, oh, why are we sitting here not growing? But we suffer from knowing the numbers. He knew that it wasn't the right time to do a deal.
Yep.
And halted acquisitions. Another story on top of that I'm recalling is before the big .com boom, right? So that was like early 2000s, I think, when the market crashed and all.
Yep.
So talks about one of his buddies called him and says, how do you feel like, you spent the past 30 years working to become a billionaire, and there's all these tech people becoming billionaires overnight? And he says something along the lines of, when it turns to cash, call me.
Yeah.
Pretty much like all of these billionaires, right, are just their inflated stock prices are what's causing it. While he was sitting on, he had the cash, right? He was a legit billionaire backed by strong assets, and there was the crash, right? So it's just super interesting, right? The grave dancer. He just always saw what was coming, and just it's insane.
He's the GOAT.
It's insane.
No doubt.
Last quote I want to talk about was he talked about getting involved in new businesses. And this podcast listener, they asked him, like, why did you always like stick with your core competencies of real estate? And of course, he's involved in some other businesses. But he says, if I can't run the business, I don't want to own it, which I think is so he said, like, if I'm going to get involved in some crazy like tech venture or biotech or whatever, like, I don't know that business. And I want to only be involved in businesses that if I had to step in and take over the entire business, that I understand what it is and how to run it.
Yeah.
So I think it's as you grow in business, right? And you start to see more shiny objects of like, oh, I can get involved in this and make this. For him, it was like, no, I'm staying focused on what I know, and I'm growing in the lane that I know.
Absolutely. I said it before, I'll say it again. He's the GOAT. That's a wrap on Sam Zell. Looking forward to doing some more of these deep dive bios on people that we love, and that we respect in business. So that's it.
Thanks for listening to episode 11, where we went through Sam Zell's life and some of the key takeaways. This was a great exercise for me, really just going deep and studying someone that's achieved massive success in the space that we're in. I think it's a great exercise to go through on your own, right? Whatever business you're involved, find someone that killed it in that space and study them, because you'll learn so much and you can essentially follow the blueprint they laid out. Some of the biggest takeaways I had from doing this was always be consuming information. And when it comes to investment principles, what is your competition? Invest in markets and places that there isn't as much competition. Risk, focus on what your downside risk is in a deal and really hammer that out and make sure the deal works if that point falls. As well as decision making. Decision making is what separates the men from the boys. I thought that was a great quote from him. And building a great team. As you scale, build a team that's going to align with your goals and create more growth. So thank you for listening.